And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is Tuesday, the day before a holiday of a holiday shortened week. So is this technically Friday? Just so we'll see. But yeah, tomorrow's a holiday for some people, maybe not for everybody, but banks. Yep, we're going to be here in the morning. We'll do a live show tomorrow, but banks are closed tomorrow, markets closed tomorrow for Juneteenth. So that's just that's going to kind of break up the week. And then we have Thursday, Friday, and then we get ready to wrap up the month and the quarter for June. And that'll take us into July, where we will start earnings season. 50% of companies right now are now in blackout. So stock buybacks are beginning to slow rather markedly, of course, over the next couple of weeks in particular. By July the 4th, by Independence Day, we'll be at 100% on the blackouts for corporations. So that buying power is going to get removed from the market. Didn't seem to matter yesterday, though. Even though we had blackouts yesterday, markets had a nice rally on basically just we're back to the Mag 7. It was a fairly narrow rally most of the day, mostly tech stocks rallying. We'll talk about that some more in a minute on the Before the Bell. Today, though, is retail sales. And so goes retail sales, so goes the market today. If that number is hotter than expected, in other words, if we see retail sales and core retail sales much higher than expectations, then we're going to probably see a market trade to the downside, yields move up a bit, because that will suggest that the economy is doing a lot stronger. That's going to keep inflation in place, more sticky than expected, and maybe keep the Fed on hold. This is how we trade everything these days. Every piece of economic data has something to do with the Fed. That's going to be the take on the market this morning. If the number comes in weaker than expected, then that should be good for stocks and both yields. So we'll see what happens this morning. Now, we've had 3 months straight of fairly weak retail sales data. So if you kind of look back, and we've done this analysis before, we had Valentine's Day, we had a retail sales number that came in. Then March had both Easter and spring break in it, big shopping days. That was still weaker than February. Then May was even weaker than that. So April was even weaker than that. So we've had a declining trend in retail sales. It would not be surprising to see retail sales come in stronger than expected today, because you've had this consistent weakness over the last 3 months. So again, even though the data has been a little bit better than expected in February and March, much weaker in April, there's been a lot of downward revisions to that. So again, would not be surprising to see retail sales come in stronger than expected today. Retail sales are a function of consumers. And so when you pull forward a lot of buying, as we did in March, for both for Easter and spring break, it wasn't surprising that April was a little bit weaker. Consumers now need to buy some stuff. So in May, did they go back out and start shopping, getting ready for summer, getting ready for vacations, those type of things? Not going to be surprised this morning if retail sales are a bit stronger. Now, there's a lot of seasonal adjustments that go into retail sales data. So there's really no telling how the data is going to come out this morning. But again, don't be surprised if that data is a little bit stronger. I'm sure once we parse into the data that we're going to still find that the consumer is probably still slowing down. Consumption is still weakening along with all the economic data. So again, just be ready for that, because that's going to knee-jerk the market this morning regardless of what that data is. It's going to move it in one direction or the other. Outside of that, there's not a tremendous amount of economic data this week. We've already got through the big reports. Retail sales is that kind of the big driver. We do have 5 Fed speakers out today. So with the FOMC meeting over last week, we have 5 speeches out today from Fed members. So those 2 are going to be moving the markets as everybody kind of parses those speeches for any clues as to when the Fed may or may not cut rates. So again, this is going to kind of be one of those days. And again, with it being the day before a holiday, volume is going to be very light. So this market's going to be potentially kind of all over the place today. So again, I wouldn't trade on a lot of this stuff today, just simply because tomorrow is a holiday. All right, let's talk a little bit about what you need to know before the bell this morning. As I stated yesterday, market started off a little bit weak and then just had a nice strong rally all day long, finished up near the highs yesterday. Market did move up to 54.70 yesterday. So again, about a 1% advance yesterday, very nice. But again, as we talked about yesterday, while markets are making that advance, they're doing so on a couple of things. First of all, volume has been a little bit weaker. Breadth continues to weaken fairly markedly. But importantly, we are now very, very overbought. And I mean, not just a little bit overbought. We are very, very overbought, at this point in terms of relative strength. Also, the current deviation from the longer term mean is getting fairly extreme here and is something worth continuing to pay attention to. Again, with that overbought condition, this deviation from the 50-day is getting fairly extreme. We kind of covered this yesterday. Typically, when we have deviations of kind of this magnitude, you eventually are going to get a correction back to that moving average. Moving averages are a lot like gravity. So the further you get away from them, the further you deviate from that average, because an average is price over time. So you have to trade both above and below that average over a particular time frame. That's what creates the average. So they're like gravity. The further you get away from them, the more that they want to kind of come back to earth at some point. So again, with this deviation that we've got currently set up between the price of the market where it is now and those underlying moving averages, with the market overbought at the same time, some type of corrective action here won't be a surprise. Again, nothing major, but a correction back to that 50-day moving average is going to be roughly about a 4% decline. So again, it's not insignificant, but with the markets having been so kind of non-volatile as of late, at 4% correction is going to feel a whole lot worse than it is. Kind of think about the way you felt back in kind of April when we had a 5% correction. We had people getting very, very like, oh my gosh, what's going on with the markets? Again, that was a very normal correction, low volatility, normal correction, back to the moving average. It came right down to the 100-day moving average, held onto that. 5.5% correction. People were under a lot of pressure because of the decline in the markets. Because this market has been accelerating again along that 20-day moving average, we've had a nice advance here over the last couple of months. When we do get a correction, now again, it doesn't mean a correction has to start tomorrow, but when we do get a correction, it'll be 3 to 5%, and it's going to feel just like it did in April. It's going to just feel a lot worse than it is, and that's because we get into these really complacent positions within markets where it's like, oh, this market just goes up every day. Whatever I buy, it just goes up. It's all great. And then when something goes wrong, you find out just how much risk you got. And again, with investors really piling in to just a handful of stocks, they're taking on a lot of excess risk. This is part of kind of our technically speaking post on the website this morning at realinvestmentadvice.com. Investors are becoming very aggressive about their equity allocations, and they're tending to do that in a more consolidated fashion. So when the correction comes, your portfolio will likely decline more than the markets because you've taken on a lot more risk than you realize you've taken on, because you've been crowding into fewer and fewer investments because those are the ones that have been going up versus the other stuff. So again, just be careful here. This is why we consistently say, when you're at these levels, do a little bit of risk management. Take some profits, rebalance your portfolios, reduce stuff back to target weights. Do kind of just follow your protocol to manage your portfolio risk, and you'll do a lot better over time. And then those drawdowns won't hurt as much. All right, that's what you need to know before the bell this morning. We'll come back, pick up with John Penn this morning, a few things to get into, but we will talk a little bit about consumer survey that just came out from the New York Fed. It's really kind of some fascinating data in there about what consumers think about the markets right now. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will NVIDIA go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. John Penn joining me as always on Tuesday. John, how are you?
Good morning.
Good. So you have an interesting question this morning from a prospective client that you're talking to, and I thought it fit in really well with an article that I just posted this morning on the website, one of our latest research pieces. It's always funny, I wrote that article last Friday about James Grant and interest rates, and I've just been getting people coming out of the woods going, they have to go higher. I'm like, why? Show me your data, right?
Yeah.
And but it's interesting. It's it's kind of the environment that you get in, right? Mm-hmm. It's all about psychology. Anyway, we'll go through the question because it's a really good setup for this article I want to discuss with our chat members this morning.
Yeah. So just as of late, hearing from more folks around, hey, should I? John, what do you think? Maybe I could be a little bit more aggressive with my portfolio. Maybe I don't need to be as conservative as I think. So I had a question come in from a gentleman who was thinking about taking his current allocation, his current portfolio to stocks right now is 90% equity, 10% bonds and cash, and he's thinking about going to a all equity portfolio or a 100% equity portfolio. Now his time frames for this is about 30 years, but again, he's wanting to Sure. Asking if it makes sense to maybe position the portfolio to be a little bit more aggressive, right?
Right. So, first of all, if I have 30 years, 100% equities is probably fine.
Sure.
Right. And so it just as long as you're managing the risk along the way, but you can also go back to I had 30 years to retirement in 1999, and for the next 13 years of my 30-year horizon, let's call it 15 years. I made no money.
Yeah.
Right. So that only left me 15 years now to get to my goal. And I have the same amount of money I had 15 years ago. Right. So it's really important to understand timeframes, duration, what returns are, and of course, managing the risk along the way, because again, you can't keep suffering 50% drawdowns in portfolios, and those are not going to be uncommon in the future.
Yeah.
Right. So, but it does bring up a very interesting point because, when markets become very bullish, like they are now, everybody that thought they were really conservative now are like, well, maybe I
should nibble a little bit more.
I'll be a little bit more aggressive. And that's very typical of investors. And like I said, that sets up, that's kind of a great setup for explaining, kind of where we are in this market cycle and what investors are doing, and just something to help you think about, how aggressive you actually want to be. The New York Fed, they publish on a regular basis a analysis of consumer sentiment. And it was interesting. So I'll just read you a quote. The New York Fed's latest consumer survey found that expectations that stocks will be higher in the next 12 months rose from 39% to 41% since last month's reading. At the same time, inflation expectations dropped slightly. Consumer sentiment numbers have recently highlighted how certain demographics are thriving while others aren't. Now, this was a quote from Yahoo Finance. They're wrong, by the way, and I'll show you why in a second. But with the market near all-time highs, it's no surprise that those who own stocks are feeling good. So here's the actual data. Here's the chart of the data. Now, this is the year-over-year change in consumer expectations that stock prices will be higher in 12 months. And as you notice, we haven't been, we've been at this level before, but it was in late 2017. And of course, 2018, we had that fairly big decline in 2018 over the Fed taper tantrum. Then we had the big run up in 2020. Of course, heading into 2019, everything's great. We're on fire. The world's going to the roof. Then we shut down the economy, and that's what happens. And now we're back to those levels. So again, on a year-over-year basis, consumers are feeling very confident that prices will be higher in 12 months. Now, according to Yahoo Finance, this is all a function of the people that own stocks. Now, that's not an unsurprising statement. If you take a look at the breakdown of household equity ownership of stocks, basically the top 10% of income earners own 85% of the stock market. So as asset prices rise, they feel better about themselves, right? Because they're making more money because they invest. And, everybody goes, well, that's the wealth gap. And there's certainly some arguments to the wealth gap. But it's that people with discretionary income and have higher incomes in general tend to invest more than those that don't have higher incomes because they're spending everything they can to make ends meet. So again, this is why this bifurcation exists. And, could it be better? Absolutely. Are things we could do to make it better? Sure. But it's not as nefarious as people want to make it out to be. It's just a function of people with higher incomes tend to invest. It's just the way it is. But what Yahoo Finance said is that just goes to show you that people in the upper 10% of the economy are doing great. But that's really not what the data said. If we take a look at the consumer sentiment survey data by age bracket, we find that every age bracket, they measure it by 3 age brackets, but all 3 age brackets have had very sharp increases in expectations about higher stock price. Not surprising, too. I mean, look, we hear, if you go onto social media, there's some 13-year-old pimple-faced kid that's telling you how to trade stocks on Robinhood, right? I mean, or how to buy Bitcoin or whatever it is. So there's people have now, because of social media and because of the advent of these things, we've sucked in, and this is, and in a way, this is a good thing because we are getting more and more people to invest. Unfortunately, that people with lower incomes, they invest the most aggressively, right? They're trying to get rich quick, and it winds up really costing them everything at the end of the day. But again, it's not just the age bracket. It's also, as I said, it's across income brackets as well. So both age and income brackets have had very sharp increases. And in fact, income between $50,000 and $100,000 and income under $50,000 have had the biggest increases in expectation of higher prices. So again, it just goes to show you that this market rally is now dragging literally everybody into the pool. And we can see this in particular by looking at household equity ownership. So this is total household equity ownership versus the S&P 500. Not surprising when household equity ownership is rising, market's rising with it, obviously, because we're all out buying stocks, right? Unfortunately, or fortunately, however you want to put it, we're at the highest level of household equity ownership on record going back to 2020. And again, whenever there's been very big peaks or very, very elevated peaks of household equity ownership, that tends to mark the peak of markets, not the beginning of bull markets. Because again, there's an old Sam Stovall from S&P. He once said, he says, if everybody's bought, who's left to buy, right? So if everybody's invested in the stock market, question is who's going to be the marginal buyer to keep prices going higher. Valuations also extremely elevated. There's a very big correlation between household equity ownership, again, not surprising, and valuations, because valuations are a function of price and earnings, and household equity allocations are driving the price. So valuations, not surprising, elevated. So ultimately, when valuations do a reversion at some point, then that's obviously going to lead to lower prices as households begin to liquidate shares. And if you take a look at average household equity allocations versus 10-year forward returns, 10-year forward returns are inverted. So when you look at this chart, the blue line is inverted to the black line. What this tells you is that over the course of the next 10 years, forward returns will be lower, not higher, than they are today. And that's just based on valuations. It's based on the fact that there's nobody left to buy stocks, all those type of things. Now, again, could this time be different? Absolutely. There's always that possibility. But again, this is just a lot of history that kind of tells you where we are in the markets. But, in the short term, markets are all about earnings. And at this moment, right, earnings are very, very optimistic. If you over the course of the next 18 months, earnings expectations are expected to grow by 20%. So there is Wall Street is very, very optimistic that the economy is going to be booming, that we're going to have a return to normalcy, and earnings are just going to be, fantastic for all companies in the S&P 500, not just 10 stocks. We're going to see an expansion of earnings breadth, and that will drive a earnings growth rate of nearly 20% on a year-over-year basis going into next year. Now, that would obviously support higher asset prices. Of course, the other big thing is stock buybacks, which, as I talked about earlier, stock buybacks are now in blackout. But again, there's over $1 trillion worth of buybacks right now that are supporting the market since 2000. They've been the marginal net buyer of equities. That is going to continue in the future. So there is an argument that this market can just go higher just simply from buybacks alone. But if the markets do start to decline, if the household equity ownership does decline, buybacks will stop because companies will stop buying back shares if the price is falling too much. They are just like investors. They tend to buy stocks when they're going up, not stocks when they're going down. So, that's the one thing to remember. And the biggest driver of this, obviously, is corporate profits. And when it comes to buybacks, corporate profits are a huge thing. If we do get into a slower economic environment, profits are going to slow down. And when profits exceed the price of the market, and I've got a chart here that Brent's not showing and I'm running out of time, is that, you're going to have a mean reversion. And going back to the 1950s, whenever profits have exceeded the price of the market, they have always led to a period of underperformance. So again, just something to think about. Now we'll come back, we'll tie this all in with John's question and what you should do with your portfolio. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will
Video?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So there's a whole big food discussion going on in our chat channel right now. Brent just weighed in saying can't beat a hot chocolate chip cookie from Chick-fil-A.
The Real Investment Show podcast.
I disagree because at Slotsky's not only can you get a chocolate chip cookie, you can also get a hot cinnamon roll.
That's like apples and oranges.
That is not apples and oranges.
It's cookies and buns.
But you could take a Cinnabon and put it between two chocolate chip cookies.
Yeah, well, you can take a Cinnabon
at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, give you a quick rundown on this consumer sentiment survey, and the point is that everybody is very bullish about markets right now, and that's a good thing, by the way. Bullishness causes markets to rise, and what's our job? Our job is to make money. So we're making money. That's what we do here, right? So, it's important to understand these things. That lots of bullish sentiment right now. It's driving stock prices higher. That will change eventually, and we're going to have a correction. That doesn't mean the world is going to fall apart and there's going to be a 50% decline, right? We had a 50% decline in 2008. We had one in 1999. Those secular bear market periods, which ended in 2015, tend to last about 20 years. So we've got about another 10 years to go on this before the next quote-unquote big one comes along. And I know that may seem hard to comprehend. And again, it could certainly happen sooner, right? But just typically how these cycles work. And, we go back to 1929, had a huge crash. Markets struggled for about a decade. And then we didn't have another big crash until 1974. So, you had the 50s and the 60s were doing pretty well. Now, there was a lot of volatility in there. You had some 20% corrections along the way. You had some 30s. But you didn't have the big bear market, right? So those typically happen on fairly long expanses. So if you're waiting for that, the problem is you're going to potentially run out of time waiting on it to get in. That's kind of the big thing. So again, that's why we focus on markets here and now. And again, look, if we start getting into a position just like in 2008, there was plenty of evidence that things were breaking in the markets, and we got out. And so, you can manage the risk. You don't have to wait for it to invest. You can invest now and just realize that at some point you're going to have to sell. Now, if you're the type of person that just buys stuff and then never looks at it again, that's a different story. I don't know how you manage that, but that's just not the way we do it. Anyway, I wanted to come back to this question about, currently 90-10, thinking about going to 100%, have 30 years to invest. You just have to understand that right now valuations are elevated, consumer sentiment's very elevated, and sure, markets are going up. But this is typical, right? This is, it's interesting, a few months ago, back in October of last year, clients were calling up, prospects were, I was like, this market's falling apart. I don't, we're down, this market's declining, we're down 10%, right? People were acting like their hair was on fire, and, it's like, get me out of the markets, right? Now they can't wait to get back in, right? We got to get more equity. People that have been very conservative now starting to get, well, maybe I shouldn't be 60-40. Maybe I should be 80-20, right? That's fine, right? But, this is always the problem, is that people go, well, I'm very, very conservative. And then the market goes up and they go, well, now I'm not really so conservative anymore. I'll be more aggressive. And so, that's not investing, right? Now you're just speculating and gambling. You've got to define a portfolio allocation that generates the rate of return relative to the volatility you're willing to accept in your portfolio. And right now, 60-40, if you're a mildly conservative investor, 60-40 is great. Right? It's low volatility, it's performing well, it's doing fine. But if you're a more aggressive guy and you don't mind risk, you don't mind a 30% drawdown in your portfolio, 100% equities, absolutely. So again, there's a model for everybody. You just have to make sure that the volatility you're willing to accept, the risk, which is that risk of loss, is acceptable to you. And if you're willing to take that loss because you have time, you've got the ability to add capital, whatever it is, that's completely okay. And you can let the markets work for you. But that's the whole point of investing and the whole point of managing money. Go ahead.
Yeah, so many great points through there. So, and I get this question a lot too, is, well, why shouldn't I just have a 100% equity portfolio? Or, John, is there anything wrong with just investing in the Standard & Poor's 500 index and just let it roll? Well, so many to the points that Lance just made, how will you feel? You have to think ahead a little bit. Hey, we're all happy when markets are rising, right? 2019, Standard & Poor's 500 index is up, 31%. Even 2020, it was up 18. 2021, another great year, up almost 28, close to 29%. Then a 2022 rolls along and you're down close to 19. Hey, NASDAQ's down 33. What do you do in that moment as an investor? Do you shy away from the market? Do you hold? Or are you going to use it as an opportunity to buy a little bit more when things are on sale, right? Because it sounds so counterintuitive. Like right now, Lance is saying, hey, markets are rising, so folks are getting a little bit more aggressive. Hey, I don't mind being a little bit more aggressive. Let's add a little bit more to equities. This just a few months ago in April when the market was pulling down, 5.5%? I mean, there were some folks out there who was like, oh my God, I had to talk them off from jumping off the ledge. It's like, hey, it's a 5% pullback. Mm-hmm. This is normal market behavior, right?
And we did, and we reduced equities going into that. We had lightened up our load and kind of reduced our volatility risk at that point. But again, it's the psychological, and it's always interesting to me. Here's the big fallacy with individuals. And look, I've seen this for almost 40 years now. I'm just gonna wait for the big one, right? So I'm gonna sit in cash and I'm gonna wait for the big one. And when the big one comes along, I'm gonna buy everything really cheap. They don't. And I have example after example after example of this. 2008, right? People were losing their mind. And so you were sitting in cash from 2005 to 2008, waiting for the big one. The big one comes along, nobody bought, right? Because they were scared it was going to keep going down. And, this is the problem that we get ourselves into psychologically, which is, I'm going to wait for the big one. Then you have a big correction, 2022, but you don't buy it because you think it's going to keep going down. There's always some bearish reason out there some YouTube channel, whatever it is, like, oh, this is, and I just talked to you yesterday about James Grant and interest rates. This is, interest rates are going to go to the moon because of debts and deficits, and no evidence of that. But, now there's a whole generation of people that are scared to invest because James Grant said this. There's always a reason not to invest. The harder thing is to invest and then manage the risk. And understand that I'm investing and I'm going to potentially take some losses. That's a function of investing. But I can mitigate how much loss I take by a proper allocation, risk management protocols, those type of things. That's why we talk, every morning is like, hey, markets are really overbought here. Take some profits, reduce risk, reduce stuff back to target weights. Just do some of the gardening, right? And that reduces that risk in the portfolio. But you can do that just... The general thing is when markets are going up, everybody goes, well, I don't want to sell anything because it's still going up, right? And then when it corrects a bunch and they lose all their profits, then it's like, well, now I'm going to sell everything at the bottom of the sell-off, right? And this is that psychological behavior that just leads to bad outcomes over and over and over again.
Yeah, it's, going back to that, waiting for the big one, I still visit with so many individuals and families every week where they've been waiting for the big one since 2008 and you've never gotten in. Q1 of 2020, when we were going into economic shutdown mode, and I mean, other than short-term T-bills, everything went on sale. High-quality corporates that you could have picked up at a discount with great yield to maturity. Preferred stocks that usually have a par value of usually roughly about $25 per share. Yep. You could pick those up too. Equities, oh my gosh, it was... You could have been a kid in a candy store, but it was just, get me out. I don't want it. It was like when it doesn't feel good to invest, that's usually the time when you should be buying, right? But it's just hard. And I get it because we're all, as humans, it's emotional, especially when it comes to our money. I get it. I mean, it's hard. It's emotional. But to your point, you can kind of manage that risk along the way. So, Lance, in the previous segments, you were talking about, household equity ownership, and it's at all-time highs, et cetera. I can hear folks already saying, well, then I'm going to wait. I'm not going to invest right now. I'm going to wait. So even for folks that are sitting in cash now that have been waiting to invest, this doesn't have to be an all or none decision. You can nibble and start to build in. I mean, what are your thoughts around that?
No, I mean, that's it.
Yeah.
I mean, it's the part of the process of you got a bunch of cash, right?
Yeah.
Let's say you got $100,000 and I want to invest. Just take 1/12 of that and invest it in the market. Next month, do another 12th. Next month, do another 12th. And work your way in over time. And you're going to kind of just dollar cost average your way in. But yeah, you're going to get some months when market prices are higher, get some months when markets are lower, and you're kind of get a decent entry point. You're going to get some NVIDIA too high. You'll get some NVIDIA that gets oversold, right? And so whatever you're buying, I'm just using that because that's the darling of Wall Street right now. But the point is that you got to start, right? It's like anything. It's like, I'm going to train to be a marathon. I'm going to train to go run a marathon. Never ran a marathon in my life, right? But I'm going to sit on the couch until the day of the marathon, right? I'm probably not going to go.
And the day before, I'm going to quit eating my ho-hos.
Exactly. But you got to just start, right? And you got to get started. And most importantly, is just building that discipline, building that process of investing and being diligent about it, but managing it, right? And again, there isn't investing is not a hands-off game. And I'm not saying that you need to day trade. I'm not saying that at all, but investing isn't buy something, sit on it, come back, look at it in 5 years. You may turn out great, and then I can give you a whole litany of companies that weren't around anymore in 5 years. So, you have to manage. You don't need to look at it every day, and you shouldn't. You shouldn't look at your portfolio every day. You should only look at it once a month. You'll do a lot better if you'll start looking at your portfolio once a month or once a quarter.
I agree.
But if you would do that, you'll become a better investor over time. But, make changes when they need to be made, not just because of emotional biases. All right, quick break. We'll come back. I want to talk a little bit about, you brought up bonds. Mm-hmm. And so we'll talk a little bit about, bonds versus money market funds.
Sure.
Yep. Okay. Be right back.
Daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will NVIDIA go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, a couple of things just as we kind of go through this, talking about sentiment markets, where we are right now. One of the, another question that's been coming up a lot is, bonds, right? Time to buy bonds now because, yields are coming down. Bonds have had a big move here over the last couple of weeks. And it's always interesting, when that happens, we start getting calls from our clients that wanted to sell all of their bonds, a year ago. Now they want, now it's like, well, should we buy them? Should we buy them back? It's like, well, you kind of missed your point. And so, and this is, and we're getting more of this conversation, particularly now that, money market yields or will start coming down. And we've talked about this before, T-bills are great, right? But they mature on a fairly short-term basis when they're a bill. And by the time they mature, interest rates are going to be a lot lower. So now what are you going to do with your money, right? This is the risk you get yourselves into. And, T-bills are fine. You can lock in a 5% yield. I can do that in a money market account as well, or could. And as rates come down, as the Fed starts cutting rates, those rates are going to fall very sharply. And because that's what the Fed controls. The Fed controls the front end of the curve. So as the Fed starts to cut rates, those T-bill rates will come down. Now I'm no longer getting 5%. I'm getting 4 or 3 or whatever it is. And the question is, okay, well, what do I do now, right? Where do I put it? Well, this is where you're going to get stuck because as the Fed is cutting rates, theoretically markets are going higher because the Fed's cutting rates, providing more accommodation. Maybe not. Maybe this time is the time they cut rates and stocks fall rather sharply. And so then you can go from, bills to stocks. Maybe that's the case. We won't know until we get there, but there is getting to be a point where when bills mature, there may not be another high yield option that is low risk to move money into. And again, we'll just have to wait till we get there. But this is why when the 10-year Treasury rate was at 4.7, 4.8, 4.9, we were talking about, hey, this is a great opportunity to buy bonds because that you're going to lock in that rate for 10 years. So regardless of what happens with rates, you've got a 5%. And if your goal was, we have so many clients go, well, I just need to make 4% a year. Well, you had an opportunity to lock in your money for 10 years at almost 5%. and not have to worry about it, right? But we were worried. What were we worried about? Oh, we're worried about interest rates keeping going up, right? Bond prices going down. Why do you care? If you own a treasury at 5% and you only wanted 4%, why do you care? Interest rates can go to the moon. You're still going to get all your money back plus your 5% interest over the next 10 years. See, this is the problem with psychology. We say we want one thing, but then we worry about all this other stuff that doesn't matter.
Yeah, because, hey, markets are up 15% this year.
Right.
Come on, man. Why should I get a bond that's paying me 4.5% where I can get 15?
Right. And that's the other side of the question, right? Is I'm getting 5, that's awesome, and you're missing out 15 on the market. So, and this is the trade-off. It's all about psychology.
Yeah, and it's the pendulum. It swings from one extreme to the other, it seems. And to your point, when interest rates as of late on the 10-year Treasury hit, 4.7 back in April. Now you're seeing interest rates pull back a little bit. And it doesn't happen in a straight line. They zig and they zag. And it's just amazing along the way. As interest rates start to pull down a little bit, get a little bit more calls around, hey, should we buy more bonds, buy more bonds, longer-term bonds. Then all of a sudden interest rates peak up a little bit. Whoa, maybe I don't want to buy them yet. Then they pull down a little bit. Oh, yeah, let's buy a little bit more. It's just this constant emotional tug-of-war, right? And what you have to do is kind of take a step back a little bit and really ask yourself, well, if I'm going to buy some bonds or if I'm going to add some bonds to the portfolio, what am I buying it for? Am I buying it for income? Or am I looking at this as a potential opportunity for capital appreciation depending on what interest rates do moving forward? Because to Lance's point, if you're buying a bond for the yield, for the coupon, for that cash flow, and all of a sudden interest rates go down and you sell that bond, now your income goes away, right? So you really have to give this some thought. But if you're buying some, let's say, longer maturity, longer duration bonds, as interest rates come down, hey, there's some great upside, price potential there with upside movement in those bond prices as interest rates come down. It's just between now and then, just realize that interest rates aren't going to move in a straight line. They're going to zigzag, and you have to be willing to hold on to that bond if you see it green on your screen or some red on your screen.
Right.
Right.
And again, the great thing about a bond versus equities, and I'm just, I was reading chat while you were talking, and a gentleman's talking about, he owns Rite Aid. The big difference between a bond and a stock is that a stock has no maturity value on it. And so a stock you can lose money in a stock for a very long time and potentially never get it back. But with a bond, it has a maturity date on it. And now we're talking treasuries, we're not talking corporates, because once you get into corporates, you have default risk. But with treasury bonds, you're going to get paid back. So yeah, you could be, and this is the again, as I was saying, this is the part that people mistake about bonds. If I own a 10-year treasury, if I'm happy with 4.9% because it achieves my financial goals in life, right? I sit down with John. John runs my financial plan. He says, Lance, with the money you have, if you just make 4% a year over the next 10 years, you're going to be golden for retirement, right? That's all you need. You don't need any more or less risk. I go, well, look, I can get 4.9 over the next 10 years in this treasury bond. So I take my entire, I'm being facetious here. But I take my entire portfolio, I buy a 10-year treasury at 4.9. I've locked in my rate of return for 10 years. I no longer now need to worry about meeting my retirement goal. In 10 years, I'm going to get all my money back. But in that process, interest rates go from 4.9 to 20, right? The value of I'm going to look at my portfolio, and I'm going to see my 10-year treasury is now down 70% in value. I've lost 70% of my money on paper in my portfolio. I haven't lost it. Yes, it's down. But in 10 years, I get 100% of my money back. Plus, every year, I get that 5% rate of return, right? For 10 years. And see, this is the mistake that people make. They worry about, what I was talking about before. You will do so much better investing if you will just look at your portfolio once a quarter. The worst thing you can do is look at your portfolio every single day, because that's where all these emotional biases come from. Watching YouTube channels, all that other stuff, watching this show.
Not our show.
Yeah. If you would just turn all that off, look at your portfolio once a quarter, you will do so much better over time, because you're going to strip out all of that bias, right? All that emotional weight you'll get rid of. You look at your portfolio over the last quarter, you go, oh, look, I'm up 5% over the last quarter. And that's great, because you didn't even see that, 5% correction that you had back in April, right? April, May, June, right? We've already passed that. We're all at new time highs. And if you looked at your portfolio March 31st and then looked at your portfolio June 30th, you wouldn't even see that 5.5% correction. And all that stress that you had over that 5.5% correction, you wouldn't have even felt it. You would have just been on with your life, enjoying your family, doing your job, creating your wealth through doing what you do, which is work. Let your portfolio do its job. Look at it once a quarter. You'll do a whole lot better.
Yeah, and don't let the narratives out there. And what you're doing is you're separating yourself away from the narratives that all those various media outlets, they want to suck you in, right? They want your clicks. They want you to click on this and click on that. They need their advertising dollars. So if you can separate yourself, one, by starting, distance yourself from your portfolio, distance yourself away from the social media aspect of things, I think we're all going to be better off. It's funny you mentioned this. So about 2 years ago, started working with an individual where he was very into, he was checking his portfolio every day to the minute. Like he was retired, but now his job was being there at his screen when markets were open to the close. And it finally just got to him. It just stressed him out so much where he reached out to us, and so we started working with him. And I almost had to wean him off. I had to wean him away. And he promised me, he's like, John, I'm going to start, distancing myself from this. I'm no longer going to look at this every day. He said, I'm just going to look at it once a week. Then once a week turned into once a month. And then once a month turned into once a quarter. And you could just sense the change in him over time, where he just wasn't nearly as stressed, and he was, spending more time truly doing the things that he and his spouse really enjoyed, right?
Yeah.
But I knew when he got a little rattled a little bit, because then my inbox started filling up. I'm like, I know what you're doing. Just take a step back. Let's talk, but just take a step back. It'll be okay, right?
It's just a function that we have to figure out a way to handle our emotions. And some people are great at it. There's the people that make the best traders are the ones that have no emotions. If you're like Spock and have no emotions, like I don't give a crap about anybody. So I'm a good trader because I don't care. But if you have no emotions, you make a really good trader. And you can sit there in front of a screen all day and you can trade and you can do well because you have no emotion. If things go up or down, it's no big deal. But if you're very emotional, right, and you worry about every little tick in the markets, and when you see red on your portfolio, it gives you an ulcer, you're not a good trader. You should not be trading. You need to be investing, and you need to step away and look at it once a quarter, and you'll start doing better, and you'll feel better about yourself too.
Yeah, and it's easy. I don't get emotionally attached to this either. Because at the end of the day, stocks, bonds, exchange traded funds, they're objects. They don't know that you own them, right? It's like our house. I love our house. Am I emotionally tied to it? If somebody comes up and knocks on our door today and offers me the price I want, guess what? Honey, we're selling the house. That's it.
Go talk to my wife.
Uh-oh. Really?
Yeah.
What happened?
No. Danny and Richard talk about how I regularly sell our house. But yeah, I've had 3 times now people come up and literally knock on my door going, I want to buy your house. And I'm like, give me the number. And they give me the number. And I tell my wife when she gets home from work that we're moving. We're still married. By the grace of God, we're still married. But 3 times now, I've sold our house out from underneath her.
Fantastic.
So anyway, all right. Whole story for another day. We'll talk about it sometime. If you don't know the story about my house adventures, I've made a lot of money in houses. All right, wraps up the show for the day. Get by the website, realinvestmentadvice.com. Be sure and like and subscribe to the channel, even though y'all don't really listen to anything we're saying. We appreciate you being here because y'all are having your own conversation about fries and burgers again. I don't know what y'all are
making
doing.
Making me hungry.
There. Exactly. All right, y'all have a great day. We'll see y'all back here tomorrow. Even though it's Juneteenth, Brent and I will be here in the morning to entertain you. See you then.